You were made to blend in, but investing demands that you be noticed. While it's in your nature to defend your ego, you need to control it if you want to succeed in the markets. Because you are wired to ask why, you must learn to ask why not when investing. Before we get started, consider like and subscribing for more valuable information like this. And the top 5 lessons from the book, The Behavioral Investor, are summarized in this video. Let's start now. First key takeaway. 4 behavioral risks that will destroy your investment returns. 1. The world's greatest financial intelligence is useless if it is not combined with an equal amount of self-awareness. As a result, we'll begin this video by outlining 4 distinct behaviors that you should avoid if you want to master the Midas touch. Ego. Men are particularly at risk from this behavioral risk. Nearly all of us, in one study, the result was actually 100%, believe that we are better communicators than the average person, and 94% believe that we are more athletic than the average person. In terms of statistics, I imagine it would be challenging to demonstrate how 94% are above average. This hurts us in investing in a variety of ways. I'm not just talking about men anymore, but we are the worst at this. Ego, among other things, makes us look for information that supports our beliefs rather than challenging them. We are not looking for truths in this search. Instead, we're looking for solace. Mr. Market, regrettably, is not a reassuring person. Conservatism. 55% of all family violence takes place in alcoholics' homes. Growing up in such families causes emotional or physical harm to many children. Therefore, it stands to reason that these kids would go above and beyond to avoid finding themselves in the same situations as adults. The data presents a different picture. Up to 50% of alcoholics' offspring marry another alcoholic. The cause of this is conservatism. The devil that we know is what we prefer. Holding on to losing positions is one of, if not the most typical investing mistake, which is caused by this behavioral risk. Attention. We focus far too much on stories and far too little on numbers and statistics. A memorable story, or one that is genuinely terrifying, sticks with you. Numbers don't work that way. Numerous issues result from this. During market crashes, for example, while CNBC, Fox News, and the Wall Street Journal broadcast live 24/7 about how the world is about to burn to ashes, it is nearly impossible to remember that corrections in bear markets are common and nothing to worry about. Emotion. Students were the subjects of an intriguing study that looked at their sexual preferences. To determine their propensity to engage in odd, sexual behaviors, cheat on a significant other, and have unprotected sex, 19 questions were asked. Typically, students would avoid such pursuits. Following the viewing of pornographic images, the same 19 questions were now posed to a different group of students with the intention of stirring up their emotions. The outcomes were astonishing. The students had a 72% higher likelihood of engaging in odd, sexual behavior, a 136% higher likelihood of cheating, and a 25% higher likelihood of not donning a raincoat. Morale, protection, and prevention vanished from their radars. Similar to this, when you invest while feeling strong emotions, not necessarily sexual ones, the set of rules you typically follow in the market will be completely ignored. It's not so much that you suddenly discount their importance as it is that you completely forget about them. How to control the 4 behavioral risks, Part 2. The second key takeaway is how to control the 4 behavioral risks. The human brain is a marvel. And in most ways, not even the best robots or artificial intelligence can match it. But, as we saw in the previous takeaway, it's a miracle for a different time and place than investing in the 21st century. Find out what we can do to control ourselves so that we can handle the challenges we face. Ego. Share your wealth. Recognize that no amount of thorough analysis can guarantee your safety from unforeseen events. The amazing and motivating CEO who contributed to your decision to make a particular investment could pass away suddenly from a heart attack. So, spread your funds among at least a few different investments. With only a few holdings, risk, defined as the volatility of returns, rapidly declines. Those that can, instruct win. It should be simple to persuade someone else of your choice if you are truly confident in your investment decision. Try it. Then try again. Make it a point to constantly evaluate your fundamental presumptions. If you decide that Apple is a fantastic investment because you believe it has great potential in the 3D printing sector, or whatever, think of a few reasons why you might be mistaken. Conservatism. Slightly, put off something. According to research, subjects choose a default option in 82% of cases when under time pressure but only 56% of cases when given some thought time. By taking your time, you can avoid being a market default picker like the other sheep in the herd. No remorse. Regrets can paralyze you, which will seriously harm the returns on your investments. This is why you ought to develop and use a stock picking system that is based on rules. You no longer have to blame yourself for your poor decisions. You now have a scapegoat. You weren't at fault. System was to blame. Better make changes for a second round. Toggle the script. Charlie Munger, Warren Buffett's right-hand man, asserts that you must always invert. This is his way of saying that if you turn a problem around, you can look into it more thoroughly. Rather than pondering the question, why do I want to invest in Tesla? Why wouldn't I want to invest in Tesla if you are already bullish on it? Attention. Play the odds and drop the narrative. Here is yet another warning about reporting on financial news during market turbulence. If we are to believe approximately 200 years of history, the expected return on the stock market is between 8% and 10% annually. This means that you typically receive $7 to $8 back annually for every $100 you invest. Therefore, in a bear market, resist the urge to bolt just because the latest news has you convinced that everything is going to hell. It isn't. And let's just say that if I'm wrong about this for some reason, investing in the stock market will be the least of your worries at that point. Look for straightforward remedies. Sometimes the investor finds himself unable to distinguish between the forest and the trees. He might expend so much energy on some investment details that he loses sight of the big picture. Once more, the answer is a rule-based system that considers this. Size counts. Let's revisit the topic of men's egos. Some men who have enormous egos also have enormous. No, hold on. What was this argument about once more? I was going to say that it's equally important to take into account the magnitude of the impact if the event occurs, in addition to the likelihood of the scenario. Take a look at these two stocks. Which would be the wisest investment? I'll let you and your readers debate this in the comments. Emotional reflection. Financial market-related emotions can typically be divided into two categories, fear and greed. It appears that meditation is amazing for controlling both of them. Automating. This advice may be getting old by now, but allow me to repeat it. In order to become a great behavioral investor, you need a rule-based system. This also applies to overcoming emotions. Recognize your emotions. You can learn to avoid investing at times when you are more likely to make poor market decisions if you can learn to recognize your emotional state. Away from your stock portfolio if you are hungry, angry, lonely, or tired. 3. Creating a successful rule-based system. The third lesson is on how to create a successful rule-based system. You may have already noticed this, but implementing a rule-based system for your investment approach can be a common denominator and solution to many of the issues brought on by behavioral risks in the market. Right now. This does not imply that we should reduce the awesome and analytical process of selecting great investments to a routine task that can be carried out without imagination or analysis. It entails creating a plan while you're sober, so that you can still apply all of your knowledge and wisdom even if you experience a blown-up ego, paralyzing conservatism, a momentary attention disorder, or an emotional roller coaster. It is frequently both intellectually challenging and rewarding to set up such a framework. 3 requirements must be met by a rule-based system in order for it to be successful. Empirical evidence. The first of the 3 points is the most obvious. When you look at how your rule-based system has performed in the past, it should be profitable. 2. Support from theory. Even though they have nothing to do with one another, correlations, data moving in tandem, will result from analyzing numerous datasets. For instance, over the years 1981 to 1993, researchers discovered a 0.99 correlation, or almost perfect correlation, between the S&P 500 and butter production in Bangladesh. Because of this, relying solely on empirical evidence is insufficient. Additionally, it must be intuitively clear how your system should operate. 3. Emotional suffering. The last and most intriguing argument Daniel Crosby makes in favor of a successful rule-based system is that it can only endure the test of time if it's also mentally challenging to adhere to. Otherwise, the system's profitability will virtually disappear as soon as it is learned about and widely used. Let's conclude this video with 2 different approaches that satisfy the aforementioned 3 criteria. 4. Takeaway number 4. The benefits of value investing. Value investing is the first method that satisfies all 3 criteria. This strategy was developed by Benjamin Graham, who is frequently given credit for it, and was popularized by Warren Buffett. Basically, it involves purchasing stocks at a discount to the company's intrinsic value. These stocks typically have low asset and earnings valuations. They aren't the kind of businesses that belong in the financial news, at least not in a good way. So why does it function? 1. It is backed by evidence. This has been demonstrated countless times. For instance, over a 5-year period, low price-to-book stocks consistently outperformed high price-to-book stocks. From 1963 to 1990, low price-to-book stocks outperformed expensive stocks by almost 3 times. Low PE stocks outperformed their benchmark index with an annual return of 5% more. 2. It is backed by theory. Which would you choose? $10 for $1 annually or $30 for $1 annually? The first option is preferred by value investors because it makes the most intuitive sense. 3. Implementing it is mentally challenging. Reasons why value stocks are so inexpensive. It might be because the company in question recently became embroiled in a scandal. It might be because it competes in an unattractive market, or it might just be because profits have been declining recently. Whatever the underlying cause, the majority of the investment community dislikes these companies, and going against the tide is challenging. 5. Fifth lesson. The benefits of momentum investing. An object either remains at rest or continues to move at a constant velocity, according to Isaac Newton. This physical law also applies to the world of finance. A stock that is trending upward or downward will likely continue to move in that direction. The foundation of momentum investing is this. Momentum investors revere the saying, let your winners run and cut your losses short, in one way or another. Let's look into how it functions. 1. It is backed by evidence. Here are some examples. Stocks that outperformed the median in 1 year tended to continue doing so the following year as well. During the subsequent 6 to 12 months, winning stocks continued to perform better on average than losing stocks. And finally, since 1801, momentum effects have been present in the US. 2. It is backed by theory. One explanation for the apparent empirical support could be greed. I want to make the same investment that my friend does if he succeeds. Another explanation is a sluggish response to data that has been made public. The investing community takes some time to process new information. 3. It is challenging to implement mentally. We would prefer to hold on to our losing stocks and sell our profitable ones. It makes sense psychologically, even though it is counterproductive in terms of making money, because every stock sold at a higher price than the buying one is a secured profit, and losers that haven't been sold off yet still have a chance to turn into winners. They typically don't. What do you make of the takeaways, then? Which behavioral risk do you find the most challenging to control? Do you have any additional advice that I didn't cover in this video on how to get past them? Let us know what you think by leaving a comment. Make sure to watch my most recent video if you haven't already. See you again soon. Make sure to check out the other video to learn. Hope to see you in the next.